Hello and welcome back to our notes on job order costing. So we're resuming here on page 22. I think the video may have cut off a little bit there towards the end. So I'm going to review this problem again. So again, what we have is our direct labor of $150, 10 hours, $15 an hour. Our materials are $200. Our manufacturing overhead, step 1, calculate the rate. Estimated overhead divided by estimated allocation base of our $760 divided by our $20,000. This means we apply $38 of manufacturing overhead for every direct labor dollar that we had. 38 times the 10 hours of direct labor, because they apply it on the basis of direct labor hours, gives us $380. The total cost of job is equal to the total cost of labor plus materials plus the overhead. 150 plus the 200 plus the 380 gives us the 730. You can see right over here I do have 380 as one of the answers here, but that is only the overhead. That's not the total cost. The total cost of the job is always equal to labor plus overhead plus materials. Okay? So let's move on to page 23 here of your notes, looking at some journal entries. Okay, so we'll go ahead and do some of these journal entries. So it says right over here, our Henderson Manufacturing Company uses a job order costing system, so we're going to use some journal entries. So just remember our accounting equation with our debits and credits. So debits increase, credits decrease assets, credits increase liabilities and equity, and debits decrease liabilities and equity. Remember, revenues, I'll say increase, and so I'll put a C to increase. And then I'll say expenses, they decrease equity, and I'll put a V to recognize expenses. And then we have is owner investment. Remember, owner investment increases equity, so it's a credit to recognize owner investment. And then we have withdrawals, okay? They decrease equity, and so therefore I will recognize withdrawals they are recognized with a debit. So withdrawal money is a debit to withdrawals credit cash. Okay? So we can use this to help us answer these questions. So raw materials purchased on account. When you see this purchased on account, that means accounts payable, part of the credit card. So the journal entry becomes a debit to raw materials because raw materials is an asset, and a credit to accounts payable because accounts payable is our liability. So the convention, of course, is to write my debits first, 159, and I come down to the next line and I indent, and I'm just going to write AP for accounts payable. Okay? You can write out the full accounts payable, or you can just abbreviate it AP. It doesn't really matter. Raw materials used. Remember from that diagram that we went over earlier in the course back, the direct materials go straight to WIP. The indirect materials, on the other hand, go to manufacturing overhead. And you can think of manufacturing overhead as a temporary area where we're going to hold our overhead expenses, and then we're going to then apply overhead on a periodic basis to work in process. Okay? And then, of course, from work in process, once the good is finished, it moves from work in process to finished goods, and then finished goods to cost of goods sold when it's sold. Okay? So when we look at our raw materials used, our direct materials, they go straight into work in process. The indirect materials, as I mentioned, they go into overhead, a temporary area where we're going to hold our overhead expenses. $16,000 right over here. Then we can credit raw materials because it's moving out of raw materials, and raw materials are an asset account. And the way I decrease an asset account is with a credit, so that's $68,000. WIP is another asset account, and so work in process WIP is going up by $52,000. The direct materials manufacturing overhead is just a temporary area where we hold all of our manufacturing overhead in our indirect expenses, so it's debit to $16,000. The same idea for our labor costs. So we debit WIP for the direct labor. We will debit manufacturing overhead for the indirect labor of $17,000, and then we'll do wages payable, okay, for the summation of our $45,000 right there. Paid the $45,000 labor cost, so it's a debit to wages payable. because wages payable is a liability, and the way I decrease the liability is with a debit. And what do I pay that with? Cash. Cash is an asset. Cash is going down. $45,000. Right? We look at this next one that we have, depreciation on sales office equipment, $3,200. This is not manufacturing overhead. This is a period cost because it says sales office equipment. Now the journal entry to recognize depreciation is a debit to depreciation expense and a credit to accumulated depreciation. And accumulated depreciation is a contra asset account. You take the cost of the asset, the original cost of the asset, minus the accumulated depreciation, and that gives you the book value of the asset. Right? The important thing here is this does not go to manufacturing overhead because it's a period cost. Look at the next one, other overhead costs incurred, factory insurance expired, $1,000, depreciation on factory machinery, $4,500, utilities for the factory, not paid but incurred, $2,200. Okay, so this factory insurance, this is a prepaid asset. It's prepaid expense. Okay, so you look over here, the journal entry to recognize the expiration of a prepaid, something like prepaid rent, or prepaid insurance, is a debit to insurance expense, credit to the prepaid insurance. But rather than going to debit to insurance expense, we're going to move it into manufacturing overhead. Okay, so we're kind of keeping track of all the overhead expenses in one big bucket of manufacturing overhead. That doesn't mean that a company couldn't have more detailed chart of accounts where they have manufacturing overhead, insurance expense. We're just not going that far in the class. We're just putting it all into a big bucket of manufacturing overhead. All the indirect expenses, all the indirect product costs go into manufacturing overhead, and then they eventually get applied to work in process, which is something that we'll see a little bit later. Okay, journal entry. Well, right here. Other factories. So let's look at this one. I'm going to debit WIP for all of these. I'm going to add up all of these. These are all overhead expenses, so I'm going to add up all those. And when I add them all up, I get $7,700. I'll credit prepaid insurance. Okay. For $1,000. I will credit accumulated depreciation, just like I did in number 5, for my $4,500. And then I will credit utilities payable for $2,200. Okay? If it said utilities paid, then it would be a credit to cash, but it's not. It says utilities for factory, so it says incurred, but it doesn't say paid. Factory overhead. So if you look back at that figure that we have earlier in the course back, you would see that we went over in another lecture video. You would see that manufacturing overhead is applied to work in process. So basically what I'm saying is that we're going to take it, we're going to move it out of the manufacturing overhead and move it into work in process. That's what I mean by applied overhead. Okay? So it says right over here, manufacturing overhead is applied at 35% of direct labor costs. So what this is saying is that for every direct labor dollar, I apply 35 cents of manufacturing overhead. So now I look over here and I look at my direct labor costs. What I have is my $28,000 is my direct labor. So I'm going to go 28,000 times 0.35, okay, which is going to come over here. It's going to equal our $9,800, okay. And then what I'm going to do is I'm going to move it into WIP. Apply. So the journal entry to apply overhead is debit WIP, credit manufacturing overhead. So I'm moving it out of the manufacturing overhead bucket and into work in process. It's a debit to WIP because the amount of inventory is the dollar value of the inventory is going up because I'm applying manufacturing overhead. WIP is an asset account. The way I increase an asset is with a debit. That's why it's debited. Okay? The next one that we have is sales staff travel costs were incurred, $4,500. And again, this is not manufacturing overhead. This is another period cost. So I come over here and I can just say sales travel expenses, $4,500. It just says incurred, not paid, so I'm going to move it, I'm going to credit accounts payable. If it said paid, then I would credit cash. Okay? And let's take a look at these last two. Let's say the cost of the jobs completed, $64,000. This is cost of goods manufactured. So the journal entry to recognize cost of goods manufactured is a debit to finished goods. Because what we're doing right over here is we're moving it out of work in process. Once it's been finished, it moves out of work in process to finished goods. Work in process of asset account, so work in process will be credited. Finished goods is an asset account, and finished goods is going up, so it will be debited. So it's a debit to finished goods, $64,000. Credit to work in process, which I abbreviate WIP, $64,000. The last one that we have over here is sold on account, $49,000 worth of completed jobs for $85,000. Remember, we have to do two journal entries. First one is to recognize the sale. This is the sale. So sold on account, that means we didn't sell it for cash, so it's a debit to accounts receivable. $85,000. Credit to sales, $85,000. Then the second journal entry is to recognize the cost of goods sold. That's this. So we're going to debit cost of goods sold for $49,000, and then we will credit finished goods for $49,000. So let's talk about these two journal entries in a little bit more detail. Whenever it says sold on account, that means accounts receivable. Accounts receivable is an asset. So I'm going to, in the way accounts receivable is going up, the way I make an asset go up is with the debit. And then, of course, sales is revenue, and the way sales are going up, and so I credit any revenue account when it's going up, because as revenues go up, equity goes up, and the way to make equity go up is with the debit. Okay? So that explains the first journal entry. Let's talk a little bit about the second journal entry, the debit to cost of goods sold, and the credit to finished goods. So let's talk about this credit first, because that's a little bit easier to explain. So I don't have the finished goods inventory anymore. Finished goods is an asset. How do I make an asset go down? Because I don't have it anymore, I credit. Cost of goods sold, COGS, cost of goods sold, is an expense on the income statement. Okay? How do I make an expense go up with a debit? Why is that? Because expenses decrease equity. Okay? So I'm going to end this video here. The next page will be page 24 of your notes, and we'll go over another problem that's pretty in-depth. Thanks.